A condo owner in South Florida expected an initial assessment of $12,500 but is now facing a total bill of $70,000. That $57,500 gap comes straight out of your pocket. Most homeowners never see it coming because of a hidden clause in your governing documents that grants the board unilateral power to levy these charges without a vote. There is also a mandatory $18,500 replenishment charge buried in your financial statement that covers zero physical repairs. By the end, you will know how to spot these red flags in your paperwork before they become a lien on your title, starting with the anatomy of a special assessment. An HOA special assessment occurs when the association faces expenses that exceed their current operating budget or reserve savings. Imagine you bought a condo expecting your monthly dues to cover everything, only to receive a notice for an initial estimated assessment per unit of $12,500. This is not a mistake, it is a mechanism where the board demands immediate capital to cover deferred maintenance. The overlooked detail here is that your governing documents usually grant the board unilateral power to levy these charges without a homeowner vote if the expense is deemed critical. While many homeowners assume maintenance is a fixed cost, it is actually a liability that flows directly to your bank account when reserves are low. You need to look at your estoppel certificate or resale package specifically for the section detailing current and pending assessments. If you miss this, you are effectively buying into someone else's deferred debt. The primary reason for these massive bills is a lack of reserve funding. If an association is underfunded, they lack the capital for major common area repairs, leading to a sudden, massive demand for cash. Imagine your building suddenly requires a total structural integrity overhaul. If the reserves are empty, the board might issue a total special assessment bill of $70,000 to cover the shortfall. This happens because the association failed to adjust monthly dues over several years to match rising construction costs. The misunderstood mechanism is that the board is not trying to profit, but rather they are forced to balance the books by shifting the entire financial burden onto current owners. You must ask for the reserve fund balance and compare it against the recommended funding levels found in the latest reserve study. If the delta between what they have and what they need is $57,500, you are staring at a high-risk financial trap. When you look at the breakdown of a massive assessment, individual items often appear as minor line items until they are aggregated. For example, imagine your share for structural concrete and balcony restoration alone comes to $35,000. Many owners are blindsided because they assume these are covered by hazard insurance, but structural maintenance is almost always a homeowner responsibility via the association. The document line to check is your Declaration of Covenants, Conditions, and Restrictions, which defines what the association is obligated to maintain versus what you own. If that document is vague, the association will almost always interpret it in a way that forces owners to pay. A real money loss scenario involves owners who ignore the physical condition of the building exterior, assuming the board has it under control. If you see cracks in the concrete or rusted railings, you are looking at your future bank balance being drained. Beyond physical repairs, there is the administrative reality of mandatory reserve fund replenishment. Imagine the board realizes they are critically underfunded and demands a mandatory reserve fund replenishment of $18,500 per unit to meet state-mandated safety levels. This is often the most frustrating part of the bill because it is not for a visible repair, but for a financial buffer that should have been built up over decades. Homeowners frequently misread their budget statements, focusing only on the line item for monthly dues while ignoring the reserve contribution percentage. You should check the board meeting minutes for the last 12 months to see if there is any discussion about reserve studies or funding gaps. If you see those words, the board is likely preparing to pass the cost of their past mismanagement directly to you. Even routine maintenance, like replacing a roof, can trigger an assessment if the reserve fund is depleted. Imagine your share of a building-wide roof replacement comes to $4,000. While $4,000 might seem manageable compared to the larger structural costs, it is often the final straw that breaks a household budget. The immediate viewer action is to verify the age and condition of the roof from the disclosure package before you sign a purchase contract. Many buyers skip this, assuming that because the roof is a common element, the board will handle it without an extra charge. However, in an underfunded community, the board has no choice but to pass that $4,000 cost to you. Always look for the roof certification or reserve study summary in your paperwork. If the roof is nearing the end of its useful life and the reserves are low, you are essentially prepaying for a repair that you should have negotiated into the purchase price. If you are in the middle of a transaction and discover a looming assessment, you have a critical decision to make. Suppose the total special assessment bill is $70,000, and the seller has not disclosed it. You need to understand that once the assessment is levied, it often becomes a lien against the property, meaning it is your debt regardless of whether you knew about it. The overlooked detail is that you can sometimes negotiate for the seller to pay the assessment in full before closing or have the price of the condo reduced by the full amount of the expected repair. If the board has already voted on the $12,500 initial phase, you have leverage. Do not accept a verbal assurance that dues won't go up. Always get a written statement from the property manager regarding any pending or planned assessments. Reading an HOA financial statement is not about being an accountant, it is about finding the red flags that indicate a disaster is coming. When you look at the balance sheet, find the line for cash reserves and compare it to the total replacement cost of all major building components. If the reserves are less than 30% of the recommended total, the community is at high risk of a massive assessment. Imagine you see a balance of $35,000 when the roof and structural needs clearly exceed $70,000.